So you're a bank in the early 1900s and you want to make more money. Your biggest money maker has always been mortgages, people taking out loans to buy a house. But buying a home at that time, even with a mortgage, was only reserved for the upper class.
Home ownership was really rare for 1900s. You look at the history of 1800, obviously there's narratives about or stories about government giving away land for free in the western territories of the United States. But really, home ownership or owning your own home was a privilege. It wasn't something for the common man.
And even so, the mortgages back then were pretty bad. You had to make a 50% down payment and the mortgage was only for 5 years. So if someone wanted to buy a $100,000 house, they would have to pay $50,000 up front, make interest-only payments for 5 years, and by the end of those 5 years, they would have to pay that remaining $50,000 all at once at the end. It was basically a convoluted way to break the payment into two while paying the bank interest, so it was still out of touch for the average person. So as a bank, if you want to make more money, you have to make these mortgages more accessible to the common man. Think about it, right now your customer base is only a tiny sliver of the population. You're only getting interest from the top 1%. But if we can somehow structure mortgages in a way where, say, 50% of the population can afford one, you are going to be rolling in an ungodly amount of interest. So you concocted a plan to get the public hooked on mortgages, and it worked. Look around today and most of the people around you will be in debt to the banks for the rest of their lives. Most people who have a mortgage right now are never gonna own their homes. They're never gonna pay back their mortgage, no. They are gonna die still in debt, and when they do die, they'll simply pass on their debt to their kids. And you wanna know the best part? Is that every single person with a mortgage today isn't even mad about it. After all, being in debt, I mean owning a home is the American dream. And this is how the banks pulled it off. It's 1933 and America is in the Great Depression, and the government was desperately trying to figure out a way to lift up the economy. Enter President Roosevelt's New Deal. The New Deal was supposed to boost the economy and promote consumerism. And part of the New Deal was the creation of a new agency called the Federal Housing Administration, or FHA. The FHA's job was to encourage more people to buy homes. Why would the government want to encourage people to buy more homes? Because when you own stuff like a home, you tend to work harder, you tend to be more productive. When you can't own stuff like in communism, you tend to not want to work. So to encourage home ownership, the FHA, this new federal agency, created America's very first home loans that were guaranteed by the government. Meaning if someone couldn't afford to continue making their mortgage payments, you as the bank could claim that money back from the government. It seemed like a genius idea at the time. Banks would give out more mortgages, so people would own more homes. But as Charlie Munger says, show me the incentive and I'll show you the outcome. FHA mortgage insurance changed the game for banks. Since you didn't have to worry about defaulting anymore, you could just freely dish out more loans to way poorer people. And so the 7, 10, and 15-year mortgages were born. But these mortgages were very different. Instead of splitting the payment into two and making interest payments over those 5 years, these new mortgages are a lot like what we have today, where people would make a smaller down payment to start out, like 20% or something, and from there, instead of having a big lump sum payment at the end, they would just have to make monthly payments for the rest of the 15 years, where every month you pay down some of the principal and interest at the same time. In the old 5-year mortgage system, for a $10,000 home at 6% interest, you would need a $5,000 down payment, and then you would pay $25 a month in interest payments for 5 years, and then at the end of the 5 years, you would be slapped with that other $5,000 payment. But with this new 10-year mortgage for the same home at the same interest rates, you would only need to put $2,000 down, much more attainable. And then you would just pay $88 every month for the next 10 years. And at the end of the 10 years, that's it. You wouldn't be slapped with a giant payment at the end. So all the commoners would have to do is pay a measly $88 every month for 10 years, and the house would be theirs. Again, much more manageable. And for the peasants who can't even afford $88 a month, you had a plan for them too, the 15-year mortgage, which would drop their monthly payments down to just $67 a month. It was genius. Suddenly, it wasn't just the rich upper class that could afford to take out mortgages, now the upper middle class could do it too. You had just unlocked a whole new segment of the population. But soon, even that wasn't enough.
So good and bad, right? It allowed more people to buy a home, but at the same time, as more demand was introduced, because there's simply more able people to buy homes, you had prices of home go up increasingly.
This is Sam Kwok, by the way, part of the Kwok brothers. They help everyday people pay down their mortgages faster. So with home prices up from more people buying, now people couldn't even afford your 15-year mortgages anymore. So suddenly you found yourself back at square one. So obviously, you only had one choice to make. Introduce the 30-year mortgage. the 30-year mortgage would change the real estate industry forever. With 30 years to pay back their loans, for that same $10,000 house at 6% interest, people would only have to pay $47 a month, down from the $67 a month for the 15-year mortgage. And it was irresistible to the masses. But here's the thing, the devil is in the details. Sure, on the surface, these small monthly payments sounded like a good deal, but if you actually run the numbers, a 30-year mortgage is actually a horrible deal. And it all comes down to a fancy term called amortization. And don't worry, this word sounds complicated because they probably want to intentionally confuse you. But all this means is that most of your monthly payments goes towards paying off interest in the early years of your mortgage instead of actually paying down the principal. And this has some really bad ramifications when it specifically comes to 30-year mortgages.
The first 10 years of a mortgage amortization, vast majority of what you're paying every single month is actually going towards interest. 5, 10, 15-year mortgages are also amortized, but if you look at the amortization schedule on a 5, 10, 15-year mortgages, they're not as that bad. I mean, you're not paying a whole lot of interest. Even from the get-go on a 10-year mortgage, really the vast majority of what you pay on your monthly payment is going to be principal payment. There's very little interest. The problem with the 30-year mortgage is that now you've allowed time to basically cook the interest longer, right? It's compounding interest that's actually working against you as a homeowner. So with the 5, 10, 15 year amortization, the interest isn't that bad. You're not paying a whole lot, even though the rate might be 5 or 6%. But the same 5 or 6% rate on a 30 years looks a whole lot different. You're paying close to almost 90 or 100% TIP, which stands for total interest percentage. If you get a $100,000 loan, on a 5 or 6% interest on a 30-year mortgage, you're gonna pay $100,000 of interest. So your entire total payment is actually $200,000 in the span of 30 years without a guarantee that you're actually gonna pay it off. So let's say you have a 10-year mortgage versus a 30-year mortgage, right? Let's say we have an example of a $100,000, 5% interest rate on a 10 years. What you're actually ending up paying as a total interest percentage is you're gonna end up paying $28,868. So what your TIP looks like, your tip, is about 28.8% on a $100,000 principal balance. But you take that same exact interest rate, okay, you take that exact same interest rate and apply it to a 30-year amortization. What you now have is a $93,256 of interest you're gonna pay. So almost 93.2% TIP, total interest percentage. It's not necessarily the rate that is the enemy. It's the time that you allow for your principal balance to compound over the last, in 30 years. That's where it becomes a problem. And of course, yes, you have a considerably less of a payment, but that itself is the problem, is that people oftentimes choose short-term gain, short-term savings, quote unquote, that's at least what they're thinking, and sacrificing long-term gain, which has a considerably higher opportunity cost.
It was genius. For most Americans, the only thing that they really cared about was whether or not they would be able to make the monthly payments. Nobody cared that you would end up paying almost double the price for a house when you tack on the interest. Nobody did the math. They were all too starry-eyed with the fact that they could own a house, even though they were just school teachers or hairdressers. But up to this point, owning a house was still a little bit of a nice to have. Now that you had these 30-year mortgages, you needed to convince the masses that they didn't just want to own a home, they had to own a home.
It is now possible to have the individual styling every family wants in its home and still have all the benefits of mass production. Home buyers may select any one of the authentic architectural styles.
For the next decade, you did everything in your power to push the appeal of owning a home. You needed every last American to believe that their greatest achievement, their ultimate sign of success, was owning a home. You made sure that owning a home became as important as getting a college degree, that no one could claim to be a success without owning their own home. No one could imagine starting a family without taking out a mortgage and settling down. It was white picket fence mania, and everyone fell for it. Every time a sucker walked into a bank with all that hope and optimism in their eyes, you knew they were about to make you rich. And I know what you're thinking, but Jake, isn't this okay if people eventually pay off their mortgages? I mean, they wouldn't be able to afford a home otherwise. And that is true, but here's the thing. 30-year mortgages were never meant to be paid off. See, mortgages are like a casino. Sure, some people will eventually pay off their mortgage and be debt-free, but the majority of people will lose, so the house always wins.
So basically what ends up happening is, let's say, I just bought a house and I'm living in it. I'm enjoying it, love it. But let's say, I have 3 kids and I only have 2 bedrooms in my house. Well, shoot, I'm gonna need 2 more bedrooms to be able to house all the members of my family. You choose to sell your house, you list it, you sell it, congratulations, and you end up moving to a much bigger house and you end up getting a much, obviously you have to get a new 30-year mortgage. But what ended up happening there is that in the span of you living in that house from year 1 through year 7, if you look at your 30-year amortization chart, really what you've done is you've made pretty much hardly any contribution to actually paying down your principal balance of the mortgage to actually build equity. Now, obviously there's natural market appreciation that happens 8% every year, but that doesn't always happen in a timely way, right? Sometimes market crash and market, it's all cyclical. But if we look just in your mortgage, really the first 7 to 10 years of a 30-year mortgage, vast majority of your monthly payment is going towards interest. In fact, really, vast majority of the interest you will pay in a 30-year mortgage period is going to be paid, most of that is going to be paid upfront in the 5 to 10 year mark. So when you choose to move out of your home, get a brand new mortgage, really what you've done is you've made no progress. You've not moved a whole lot in terms of getting closer to paying off your mortgage, building your equity by the time you choose to sell and move to a new house. So guess what happens? That 7 to 10 year mark of which you decided to move to a new house, when you start all over again with another 30-year mortgage, you're going back to square one where the next 7 to 10 years is now going to be interest payments, lots of interest payments, and you're not making a whole lot of stride. And most likely when you move to a bigger home anyway, you've just tacked on more debt than ever before. So this vicious cycle that most Americans are in right now, because now we're more mobile than ever, long gone are those days where you stick around to work for a company for 30, 40, 50 years and they pay you pension and you retire comfortably. That is no longer around. that is long gone, right? So now people are more mobile than ever. They move more frequently. They're switching jobs more frequently. The average person, the average adult will have 11 job changes in their career, which is a lot. And the odds of you having to move or relocate to another city or place is rather high these days because of how vast these companies are now. So with that being said, you can expect for most US adults to have 3, 4, even 5 mortgages for their personal residence. And each time they get a new mortgage, they're resetting that 30-year amortization clock. So by the time they get to their 60-year-old, 50-year-old range, they still have 30 years left to go. And so, yeah, you may have a 3%, 4% low, quote unquote, historical mortgage rates, but who cares if you have to repeat that front-loaded interest zone the first 7 to 10 years over again, literally 5 times, throughout your entire lifetime. That is where the trap is, and this is why I encourage people to really pay attention to this, even though their interest rates might be 3, 4, 5%.
Okay, so basically this whole scheme system has evolved into something where the average American, they basically become like indentured servants to the banks, where like so much of their income for the rest of their entire life is strictly just going to paying off interest, and no one even really realizes it.
And banks have, they pay, billions of dollars on perfecting the system, right? They literally hire people who graduate from MIT, Harvard, all these fancy schools that people are a lot smarter than us. They have actuaries that are like math geniuses. And what they do is they compute the risk and reward of these millions of homeowners getting mortgages. So what most people haven't really asked themselves is, how are the banks getting away with such low interest rates and yet they're the most profitable than ever before in the history? In the last 100 years. Shouldn't they have been more profitable when the interest rates were 12, 13, 14, 15%? Right? Or 8%, right? We're kind of back to that spot now. But if you really think about it, the way that they're making way more money now is they figured out what I know and what I'm explaining to you is, most American homeowners are moving 5 times their lifetime, whereas 100 years ago it was only like once or twice. So let's go and build that into the computation of risk and reward. So yeah, we can give them a 3% interest rate, but really if they're getting 5 mortgages in a lifetime and most of what they're gonna do is make interest payments, yeah, that's almost like on paper, it's going to be like it feels like a 9 or 10% interest rate, as opposed to 3% forever. So this is how the banks, you can't beat their math and the way that they're able to make their money. And a lot of people who during COVID were like, oh my gosh, I got a 2.5% interest rate. I am like hardcore winning right now. I'm saving so much money. Guess what? I mean, a little bit of secret, dude. 3 or 5 years, you're probably gonna end up moving, and whatever the rate's gonna be in 3 to 5 years, that's what you're gonna end up with. So good luck with your 2.5% interest rate for the next 5 years, but really you're gonna end up in the same spot, or in a spot where 3 to 5 years from now, the interest rates are gonna be closer to 6 or 7%. So again, the rate is not the game you should be playing. The rate is there, it's a lever and a mechanism to which the banks can use as a marketing tool, not necessarily a way for you to save or make money. So don't play that game, because that's what the banks want you to play. Okay, the moment you play that game, the moment you follow the bank's rules, you've lost, because banks have created that rule for their benefit and therefore their profit.
Mortgage payments make up 31% of the average American's household income. 31%. And you know what that means, right? Because they're going to be paying off their mortgage for the rest of their lives, you have successfully duped the public into spending a third of their lives working for you. A third of their lives as your literal indentured servants. And when they die, their kids become your indentured servants. So we are not being hyperbolic when we call this debt slavery. And when you take a step back and see all of this, you gotta give the banks some credit. This is a genius system they've come up with. It's the best business model ever. And we haven't even talked about mortgage-backed securities yet, which we'll save for another video. But let's say you're aware of this trap, and you only get a mortgage once you know for sure that you're not gonna move, that you're gonna keep this house until you pay it off. Well, not so fast, because the banks have one more trick up their sleeves to get you as well. The next way you trick plebs into being your slaves forever is with the magic of refinancing. Let's say someone bought their home at a 7% interest rate, and a year later interest rates went down to 5%. They could just refinance their mortgage and get that 5% rate, which will magically lower their monthly payment by a few $100s a month. Neat, right? The banks are really looking out for me by offering this. Or so they thought.
Oh, we're at 6%, let's go to 5% so that we can get more people to go refinance. Because I'm gonna tell you right now, refinance business is more profitable than people buy, like first-time home buying business. Think of it as like when you first get a customer, you've had to pay a lot of marketing costs, advertising costs to get that customer, right? So a lot of times when you first transact, when you first have an interaction with the customer, you either break even or you lose money. But the second time they come back to you, okay, now that's profit, right? Because you didn't have to spend money to acquire that customer again. So what banks do is, all right, because we're losing money anyways on these first-time homeowner customers, we're gonna offer a ton of incentives. We're gonna get them to buy and get mortgages from us. Once we got them, 6 to 7 years later, let's go ahead and advertise a refinance rate. So if Bob Joe got their mortgage at 6%, let's wait 5 years, collect some interest, right? And then tell them, hey, we have a 5% program, so come back in, get another 30-year mortgage for that 5%, you're saving a whole 1%, and they'll do all these kinds of advertising of going, oh, Mr. Bob Joe, you're paying $600 a month, we can get you down to $550, right? And they're gonna try to do all these types of advertisement. So refinancing is a very, very profitable business for mortgage brokers, banks, and investment bankers, because this is the mechanism to create more mortgage-backed securities. It's literally, they have to feed the beast. If Wall Street is a beast and Wall Street's hungry for mortgage-backed securities, they need to make more mortgage-backed securities. And the way to do that is get the Americans to take more loans out. That's it. And literally, the banks and these companies will spend billions of dollars on advertising, promo, incentives, right? Like I've seen some stupid things like, hey, get a mortgage today and get a free cookware set, right? It's like, what? Right? Like, and there's people who fall for it. I'm like, oh my gosh, it's like a German steel cook set. I need it, right? And they get a refinance. It's freaking crazy. So you have to understand, it's the interest rate. Yeah, that's what the Wall Street makes, but the banks also make what's called an origination fee. Okay, also known as a loan doc fee or whatever. And these are also very, very profitable to these mortgage brokers, because if they can sell a 30-year conventional Fannie Mae, Freddie Mac backed FHA mortgages, if they can sell that, they could make 2 to 3% commissions, even as high as 4% commissions off of the loan balance. So if they sell you a $100,000 FHA loan, they get to go home with a $4,000 commission check. So guess what? Their incentive is, let's get as many people as possible to get these mortgages.
But it doesn't end there. Remember how we transitioned from 10 and 15-year mortgages to 30-year ones because home prices got inflated too high? Well, the same thing has been happening ever since. So what is the next logical step? 40-year mortgages, of course, which the FHA is already testing out. And don't worry, when the day arrives and the masses can't even afford a 40-year mortgage, we'll just roll out a 50-year one. Alright, so enough of pretending to be a bank. How do you beat the banks? In other words, if you don't own a home right now, should you? Should you rent? And if you should buy, should you get a mortgage or not? And if you have a mortgage, what can you do to get out from under the scheme? Let's go over that next. So first one, we'll cover, what you recommend for a person just starting out and they don't have a mortgage yet. So if someone's just starting out, like they're in their 20s, maybe they're starting to make some money, like what do you recommend? Do you get a mortgage? Do you just rent for the rest of your life?
Yeah, so I mean, the most important thing to do is really understand how the system works, right? The moment you understand how the system works and how the game is played and what the rules are of the game, you can quickly figure out how to win, okay? Most Americans, unfortunately, and I'm not just talking about mortgages, I'm talking about money and how to make money and growing your wealth in general. Most people don't know how to play the game, or they're playing the game that's been set up for them and they don't have they don't know what other ways to play it, right? Most people are like, oh, work 40 years, put some money in the 401k, stocks, bonds. Oh yeah, I'm gonna put some money in crypto or whatever, right? Unfortunately, that's game plan for most American homeowners and people in general, but yet they fail to understand that there's other alternatives, right? There are other investment vehicles through real estate, through insurance, through alternative investment opportunities. There's so many things you can do, starting your own business. There are ways to play the game of wealth differently, and oftentimes they're way more lucrative, and the growth potential is way higher than just playing the normal average game. Same is true when it comes to paying off your mortgage. If you understand that there's an alternative way of financing and buying homes, you can actually beat the system by paying it off early. So one of the things that I teach, and this is something I teach to my clients, is a cash flow strategy whereby we're going to show you how to pay off your mortgage in as early as 5 to 7 years without paying any extra into the existing mortgage. We're not going to play that game. Without refinancing to a lower rate, because we talked about how stupid and dumb that is. We're not going to hurt our credit or modify or beg the bank for mercy. We're not going to do any of that. It's all simply by careful allocation of where you store your money. That's it. In an event where you put your money, your income, your savings in a savings or checking account, the banks win because they can take that money in your checking account, use that as a collateral, borrow more money from the Federal Reserve or other banks, and lend more money out in the form of mortgage, of course, and make more money off of your money, right? You're literally giving your bank a free loan, right? If you have any money sitting in your checking account at earning 0% yourself, the bank is taking your money and making a lot of money with it. So instead of doing it that way, what I teach is use other vehicles such as lines of credit, or you can use other vehicles related to that to take advantage of what the banks offer to then ultimately save money on interest and also pay off your mortgage faster so that you don't become susceptible to the traps that I talked about of being perpetually stuck in this 30-year death trap. That's something I teach. So know the system, understand the rules, understand why the game is being played the way it is, because it's all in favor of the banks. Yes, buy a home, but do it smart and use alternative strategies that, stuff that we teach to be able to help you. Now, there's also the philosophy of should you buy or should you rent? I believe if you are going to stick around your next home for at least 10 years, for a fact you're committed for the next 10 years and you're willing to make that commitment, then yes, buy. If you feel like, okay, I'm going to do a lot of hopping, going from one area to another area to another area, probably not the smartest thing to buy just yet. Figure out what you want in a home and where you want to be, and then make that decision. So just really understand, be educated, commit, and know thyself of where you want to be. And that's the biggest thing I would have in terms of recommendations for people just getting started out.
So there it is. Unless you know for sure that you're gonna live somewhere for at least 10 years, do not get a mortgage. And if you do get a mortgage, or if you have one already, there are ways to pay it down faster so that you can get out of this trap as soon as possible. And if you want to learn more about Sam Kwok's way of paying down your mortgage faster in as early as 5 to 7 years, scroll down and click the link below to learn more about it now. Scroll down and click the link below to learn more now. The Kwok brothers are the paid sponsor of this video, and of course, I am not a registered financial advisor, so you should definitely check with your professional financial, tax, and legal advisors before making any financial decisions. This video is for information purposes only. Stay dangerous, and I'll see you in the next one.